the outflows of equities across the globe were fairly significant. And every week, the Bank of America Merrill Lynch puts out a flow report or flows reports out of funds or into funds, whatever it might be. And it was about $133 billion globally out of equity funds, just equity funds in the markets. Now, that was the average Joe. That was the average mom and pop investor. That was institutional investors, bank investors, so on and so forth. Well, how could that possibly be? So I'm a little confused. We've seen positive markets this week, and we've seen these huge outflows. And 80 billion of those outflows, by the way, out of the 133 billion, 80 billion of it was out of American equity funds. Or I shouldn't say American. It sounds like I'm talking about the mutual fund company. But out of U.S. equity funds, and $80 billion of it. And how could that be happening? If all that money has been pulled out, that would obviously be negative on the markets, right? That's a lot of stock selling going on. But the interesting part of all of this is that central banks have continued their total disregard for any of the underlying economic fundamentals of the markets or the economies, their total disregard for that, and have been buying equities. Well, what do they know that some of the very well-trusted economists and fund managers don't know? They don't know anything. What they know is that from a political perspective, they got to maintain and continue to prop up the markets, continue the false positives in the market. This is, once again, and continues to be, a central bank-driven markets. Why on God's green earth would you want to buy in to something that is not real? Think about that. We'll be right back.